Welcome to our introduction to IFRS 9. In this video, we will explore the key aspects of this important financial reporting standard. IFRS 9 is a set of rules that tell companies how to report their finances. It provides guidelines on how to classify and measure financial instruments. The three main components of IFRS 9 are classification and measurement, impairment, and hedge accounting. Specifically, it deals with financial instruments, which are things like loans, bonds, and other types of financial assets and liabilities. IFRS 9 replaced an older standard called IAS 39 and became effective in 2018. This transition marked a significant change in financial reporting. The goal of IFRS 9 is to make financial reporting better by providing information that is more relevant and timelier. This helps in making financial statements more useful for decision-making. This helps investors and creditors make better decisions. By having access to more accurate and timely information, they can assess the financial health of a company more effectively. IFRS 9 is important for many reasons. It enhances the transparency and comparability of financial statements, which is crucial for global investors. It helps companies show their true financial position and makes it easier to compare companies across the world since IFRS is used in many countries. This global standardization is key for international business. Overall, IFRS 9 is a crucial standard that makes financial reporting more transparent. It ensures that financial statements are clear, accurate, and useful for all stakeholders involved. Let's move on to classification and measurement, a crucial aspect of financial reporting that ensures transparency and accuracy in financial statements. IFRS 9 classifies financial assets into three distinct categories, which determine how an asset is measured and reported in financial statements. These categories are based on the business model under which the asset is held and the asset's cash flow characteristics, ensuring that the financial reporting aligns with the company's strategy. The first category is amortized cost. Assets in this category are typically held to collect contractual cash flows, and their cash flows represent solely payments of principal and interest, SPPI, on the principal amount outstanding. An example is a loan where a bank expects to receive principal and interest payments over time. The second category is fair value through other comprehensive income, or FVOC. This category includes assets that are held for both collecting cash flows and selling. An example is a bond that a company might sell before it matures, allowing for flexibility in managing investments. Cash flows must also meet the SPPI criterion. The third category is fair value through profit or loss, or FVPL. This category is for financial assets that do not meet the criteria for amortized cost, or FVOCI. This includes assets held for trading purposes, assets like shares bought to be sold quickly for a profit. They are measured at fair value, with changes in value recognized in profit or loss, reflecting their volatile nature. Understanding these categories and their measurement requirements is essential for accurate financial reporting. Each category has specific criteria and implications for how financial assets are reported, impacting a company's financial health and decision-making processes. Now, let's talk about impairment, a crucial concept in financial reporting. Impairment happens when an asset loses value, which can significantly impact a company's financial health. IFRS 9 uses a model called the expected credit loss, or ECL model, to address this issue. This model requires companies to look into the future and estimate potential losses on their financial assets, ensuring they are prepared. The ECL model considers past events, current conditions, and future forecasts to provide a comprehensive view. For example, if a bank made a loan and the borrower's creditworthiness worsens over time, under IFRS 9, the bank must recognize expected losses even before a default actually happens, which is a proactive measure. This forward-looking approach helps provide a more realistic view of a company's financial position and helps to avoid surprises in the future, making financial planning more robust. The impairment process under IFRS 9 involves three stages. Stage 1 is for assets that have not significantly deteriorated in credit quality since initial recognition. Stage 2 is for assets that have shown a significant increase in credit risk. Stage 3 is for assets that are credit impaired. Each stage requires different levels of loss allowance, reflecting the increasing risk. Section 4. Hedge accounting. Hedging is a way to manage risk. Companies use financial instruments to protect themselves from potential losses. Hedge accounting allows companies to align the accounting treatment of their hedging instruments with their risk management activities. For example, a company is affected by changes in foreign exchange rates. They might use a forward contract to hedge against this risk. IFRS 9 allows the company to reflect this hedging relationship in their financial statements. This makes the financial statements more useful, giving a clearer picture of the company's overall risk management strategy. Section 5. Derecognition. Derecognition is the removal of a financial asset or liability from the balance sheet. This happens when an entity no longer controls the asset, or they are no longer obligated under the liability. For example, a company sells a bond that it holds. The bond is derecognized, meaning it is removed from the balance sheet upon sale. Derecognition ensures that the balance sheet accurately reflects the company's assets and liabilities. It also provides transparency about the company's financial activities. Thank you and subscribe for more.